Orest, thanks so much for joining me. So the background to this, and this is a last minute thing, I really do appreciate it. I know you're very busy. So it's a last minute thing. And the reason that we're having this call is that I keep getting these pings from YouTube, from folk not happy with one of the videos I've got up there. So let's make them happy with the definition. This one is the last comment comes from a fellow called Alex. I won't say his last name just to protect the innocent. And the topic is about CMBS. Apparently the definition, CMBS explained, the video that we have so far does not, what's it, meet mustard or fit mustard or whatever. It just doesn't do it. So Orest, let me ask you the question that I know Alex and others want to hear the answer to. What are commercial mortgage-backed securities? Explain what CMBS is, please.
Sure. Thanks, Adam, and thanks for having me. So very simply, CMBS are fixed income securities, meaning bonds, that are backed by commercial mortgages. So they're instruments that are used as sort of a funding mechanism for mortgages. Lenders originate loans, they package them into bonds and sell the bonds. So those investors, the buyers of those bonds, are then effectively funding the mortgages. So the market for fixed income securities is far more robust than it is for mortgages. So here's why we have CMBS. It's because the bond market is more robust than mortgages. Let's take life insurance companies for an example. As an example, they generally like commercial mortgages because of their duration. Commercial mortgages typically have 10-year lives, and they have call protection, meaning the borrower can't repay them without a penalty. So the perfect bonds, they match well with the life insurance company liabilities, the insurance policies that they pay out. According to the NAIC, I did a little bit of research before this call. 9% of Lifeco assets, Lifeco is short for life companies, are invested in commercial mortgages. Other investors are pension funds, fund managers, and banks. So there's a robust investor community. And why do they like them? They're structured. What does that mean? So picture a bucket, and a bucket gets filled with mortgages as lenders write them. And the issuer is a entity. It's not a real corporation. What's a corporation? But it's not like a legitimate. It's not Procter and Gamble, for instance. They'll package the mortgages and slice them up into tranches or classes. The classes at the top have little default risk, and the ones at the bottom have a greater risk. And the reason for that is because of the way CMBS are sequential pay. They're pass-through certificates. So as mortgage payments are made, those mortgage payments get passed through to the bondholders effectively. The interest payments go through, everybody gets their interest payments, and then the principal payments go all to the top until the top class is paid off, and then it goes to the next class, and so forth and so on. So the class at the top has the least amount of default risk. The ones on the bottom have greater risk because near the end of the life of those 10 loans, there might be a couple of stragglers that don't make their payments, and those are the guys, the holders of those first loss pieces will have to deal with them. So the top layers sometimes are referred to as first pay bonds, and the bottom layers are often referred to as first loss. And the layers in between carry varying ratings depending on their risk. Those closer to the top, of course, are less risky than the ones at the bottom. So the thinking is that as loans are performing, all bonds receive the interest payments they expect. But when something goes wrong, say one loan goes into default, there's a mechanism within CMBS that gets triggered, and that's the special servicer. They step in and they start developing a workout strategy. They get paid for that as well. They're typically special servicers. There's a dozen of them that are very active in CMBS. They're typically real estate workout specialists, and they figure out the best way of resolving any loan. Of course, they abide by something that's called the PSA, the Pooling and Servicing Agreement. That's the CMBS deal's governing documents. So say that one loan defaults and its collateral is taken, and when that collateral gets sold, there's a loss. So the sale doesn't pay off the loan in full. That loss is absorbed by the most junior class. So of course, the most junior class, when they buy those bonds, they're buying them at a substantial discount to par or face value. If it's got call it $100 par value, they might buy them for 40 cents, 50 cents on the dollar, depending. So CMBS, I think your next, what's happening now?
Hang on, before we get to that, Orest, let me ask you some questions, just to kind of clarify some of these points.
Sure.
So just for clarification, so CMBS, this is a pool of mortgages. These are commercial real estate mortgages, but there are also CMBS that apply to residential mortgages, aren't there? There's different types of CMBS, aren't there?
So you might be referring to single-family rentals,
or single-family. Yeah, aren't single-family.
So home loans, loans against single-family houses, 1 to 4. Those are typically securitized, but not through the CMBS market, through the RMBS market, residential mortgage-backed securities market, which is far more. It's a huge market relative. CMBS is almost the coins behind your sofa relative to the size of the RMBS market. The RMBS market is in the trillions, whereas the CMBS market, I think the total cap right now is about $600 billion. All
right. So commercial CMBS are commercial mortgages.
That's right.
It's not residential.
All the collateral loans are backed by income-producing properties and hotels.
Right.
Some folks don't consider hotels income-producing properties.
And now, so is another way of describing what CMBS is for a bank? Is it a secondary market? So they, in a way, they will issue these loans to their customers, and then what do they do? Do they sell them and continue servicing, or do they sell them and release the servicing? They sell them at a profit, and like, how does it end up in a CMBS tranche?
So when you say banks, there are a few commercial banks that play in the CMBS market, meaning they originate loans for securitization, for sale through securitization through the CMBS market. There are a lot of other lenders that participate. There are, if I remember the number, something like 20 lenders that participate in the market actively. But the big ones are like the investment banks, the Goldman Sachs's, the Citibanks, JP Morgan, Morgan Stanley's, those guys. Those are the big ones.
Okay,
what was your question?
Yeah, exactly? so the idea is that they don't. Okay, so banks don't issue a commercial loan. If I go to a bank and I've got an office building and they provide me with a 60% loan, they don't. It isn't automatic that they would sell that into CMBS. That is. Obviously, so our friend Alex didn't understand it. Neither do I.
So you have to the lender always wants to match their liabilities with their assets, right? So will a bank that is deposit taking, a regular bank, say my local First Union Bank Univest Bank over here, would they write a 10-year loan? Probably not, because their capital is short-term deposits primarily. So they'll write short-term loans, and those they'll keep on their balance sheets. But when those short-term loans are typically written to investors that either purchased a property to fund that property, or they want to fix up their property. So they have a 2-year, 3-year business plan. They'll get a short-term loan. But at the end of those 3 years, or when the property is stabilized, it might be time for a long-term loan, for a 10-year loan. The local bank isn't geared to do that loan, to keep that loan on their balance sheet. They would write it if they had an exit, if they could sell that loan somehow. CMBS would provide them with that exit. So, and if my local bank doesn't have a sort of a CMBS avenue, I could go to another lender that would then offer me a 10-year loan and then sell it through securitization.
Got it. So those other lenders, are they kind of intermediaries to these CMBS entities? In a sense?
Yeah, they are. Oftentimes they
like
retain
feeders.
primary servicing. They're not, I mean, they're writing a loan, selling them. Hopefully they're selling the loan at a higher price than what they originated it
Right.
for.
But they retain servicing rights, do they? The banks will retain servicing rights?
Yeah, I think oftentimes they will retain primary servicing rights. They don't, so the structure, the CMBS structure will have its own master servicer and then its own special servicer, its own trustee and stuff like that. So, but oftentimes the primary servicing, the go-between, the person that you send the check to all the time is probably the originator.
The originating bank, right? And it only really goes to the CMBS entity itself. If you stop paying, then it goes to the special service and it goes inside.
It goes to the special service. Yeah, the coupon, by the way, because these structures are pass-through certificates, so the coupon that you're paying, the bill that you get every month, that gets passed through. The check that you wrote gets passed through to the bondholders effectively.
And the I lost my train of thought there. Yes. So, right. So if you're a borrower and you decide that you want a 10-year loan, and presumably the rates are better than, doing a shorter term loan. So you're going to get better rates. Are you going to get better rates for longer term, or you're not? Well, what are the advantages from a borrower's perspective?
So flexibility. So you'll go for a short-term loan. So remember, the CMBS loans are call protected. So if all of a sudden after year 3 you lose a tenant and you need to spend a bunch of money on TI, you have no flexibility to repay that loan and get a new loan or anything like that.
So you can't you can't pay off the loan.
That's right. And there's also a lot of restrictions on what you can do, because you want to maintain the trustee wants to, or the trust needs to maintain sort of the status quo for its duration. So
in exchange for those restrictions, from the bank's perspective, borrowers are getting better rates than they would elsewhere.
Typically, and mind you, so the fixed rate loan is a 10-year loan, so the rate is benchmarked off the 10-year Treasury. A floating rate loan is typical now; it's benchmarked off SOFR, and it's adjustable every month or every 3 months, whatever the case might be. So when you get a fixed rate loan, a 10-year loan, you're paying that same coupon for the 10 years. On a floating rate loan, your rate is going to adjust every month, and given where inflation, given what we're seeing with rates now, that's going to increase on a regular basis.
And CMBS will hold both fixed and floating rate.
That's correct. Yep. So the fixed rate. So there are two basically grand categories of CMBS: conduits, which are typically multi-borrower, multi-loan transactions. So you could have one transaction with 100 loans contributed by five lenders. Citi, Morgan Stanley, and a couple other smaller lenders in there, even though Citi and Morgan Stanley haven't done a deal together. And then you have single borrower, they call them SASB, single asset, single borrower transactions. We call them simply single borrower because the property is effectively the borrower because of the way mortgages are structured. They're not recourse to the borrower; they're recourse solely to the property. So those will typically only have one loan or one loan against multiple properties owned by one sponsor.
I see.
And those oftentimes will have floating rates. The conduit deals are always fixed rate.
Right. And one of the challenges, so a friend of mine owns a couple of major hotels here in the Los Angeles area, West Side area. And during COVID, I asked, were you able to negotiate with your bank on the loans? And he said, no, these were CMBS loans. And we just had to keep on, there was no negotiation. Just talk to me about the difference between working with your local bank and working with the CMBS.
That's always been a criticism of CMBS. So CMBS loans, because it's a bond instrument and it's loan pricing is determined by the bond market, oftentimes you can get much better rate and you typically could get better proceeds than from other fixed income lenders, fixed rate lenders.
Better proceeds meaning more percentage of the purchase price.
That's right. Now, getting back to COVID, so the CMBS market, the CMBS industry recognized that we were facing a real headwind. They developed a plan to provide, not blanket, I mean, you had to ask for it, and there were a lot of restrictions to it. They gave what they termed forbearance, which is effectively debt service deferral agreements. So they allowed certain borrowers, certain sponsors to defer debt service payments for 3 months to 6 months, with the understanding that they would pay it all back within the next following 12 months. A lot of, I mean, I couldn't, I wish I had the number in my head, but I don't, but it was a substantial volume of hotel properties and some retail properties. Also, a lot of the big Brookfield, Pyramid, they received debt service deferral agreements.
Right. So this was okay. You don't have to pay for 6 months, but then you got to pay back the deficit and keep it current for over the next 12 months.
That's correct.
So we're giving you some breathing space, but that was exceptionally unusual circumstances, wasn't it?
Oh, very. Yeah. Typically, I mean, that's been the criticism of CMBS loans, is that they're very rigid. There's no flexibility. And there's complaints that we've heard from borrowers is, you know, I've got this new tenant coming in and I need to pay TI to get the space fitted out for them. They won't allow me to get the servicer, the CMBS servicer won't allow me to tap my reserve to do that. There are issues like that.
Oh, I see. Wow, that is pretty.
Yeah, it's stringent, but you have to dive into these things with your eyes wide open. You always have to know how deep the water is.
Right. And so when a borrower decides to go the CMBS route, that's because they accept the restrictions, but they're looking for better terms, is essentially what they're looking for.
Yeah, that's right. It's a very competitive market, even in a mortgage market.
So now they get their loan, and there's thousands and thousands of these loans that are made, and they're held within CMBS instruments. And CMBS, they have names, right? Each CMBS security itself has a name. Give me an example of a couple, like the name.
Sure. So we've the last two deals. So Bank 2022 BNK 42. See, that's pretty clever, right?
That's the name of it is pretty clever. That's the name of a tranche of securities of CMBS securities. Tranche, right?
That's right. And the reason why they call it that is, so there's been the thinking has always been that certain bank lenders provide write better loans, loans that tend to perform better over time. The global financial crisis kind of threw that out the window, because a lot of these bank written loans didn't perform as well as they'd expected. But so these are the three banks that contribute to this are Wells Fargo, Morgan Stanley, and Bank of America, and their loans are written relatively conservatively. I mean, if we look at the underwritten loan to value and debt service coverage ratios, and again, this is underwritten levels. So that deal, that BNK 42 deal, had a 52.5% loan to value ratio on the aggregate, right? That's pretty low, but then when you go, that's like the average for all the deals that have been priced so far this year for all the Conduit deals. But then if we go to their debt service coverage ratio, 2.56 times, which is
crazy,
which is nice. And the debt yield, this is the differentiator. Their debt yield is 13.1. So it's more conservative. All the other deals are between 10 and 11 and a half, around there.
So, and then on last question about CMBS, actually, not actually the last question, I've got a couple, but are they kind of structured in any way like REITs, in the sense that a CMBS will be just hotels or just multifamily or just office, or do they are there blends? How does that work?
Yeah, so on the Conduit side, you want a diverse pool. And in fact, you want more multifamily and industrial than other asset class, than other property types, because those investors tend to like those. Now, with multifamily, the problem is you're competing against the agencies, the housing finance agencies, Fannie Mae and Freddie Mac. And the thinking has been historically, well, if a multifamily loan is in CMBS, that means Fannie and Freddie didn't want it.
Didn't like it. Yeah, I see. Yeah. So it's in this case, CMBS would be a finance of a last resort kind of thing.
Yeah, or at least that's in some circles. You say, well, why does it have such a big exposure to multifamily? That means it's a lot of multifamily that the agencies didn't want. But
interesting.
That's just what folks tell us. I'm not passing judgment or anything like that. So get back to your question. So the conduits are always a diverse pool, but the single borrower deals, you'll have deals backed by one hotel, backed by two hotels, and there will be individual property assets. And if you're, just think about it, if you're an insurance company that you, historically, a large loan against a big hotel, an insurance company or a couple of insurance companies would have banded up together and written that loan. Well, now CMBS could write the loan and sell the bonds, and the insurance company could just buy the upper tranche,
right?
Get access to or get exposure to that asset that they like, but only a senior exposure to it. So they have a lot more subordination, meaning a lot more credit support or more protection on the bottom.
They're the first ones out. And so actually that was what I was going to ask. That was actually my last question before we move to what's happening at the moment. So just the last question on that. So when somebody buys a bond that is, and correct me if I'm not quite getting the jargon right, but if they buy a bond that is secured by CMBS,
they're buying a bond from a CMBS transaction.
Okay, so they're buying a bond and it has a face value, and it might be $100,
right? And
it pays a certain coupon, a certain yield that you get on that bond. So that upper tranche, you will pay close to, if not, but in some cases even over
par
face value, which affects the interest rate that you're going to get. And the lower you go down on the tranche, you don't get a different interest rate. You just get a discount on what you pay for the bond.
So on CMBS, it's almost all there. So it's CMBS because it's layered into tranches. Each layer has its own coupon, right?
Different interest rates.
That's right. That's right.
And so you will pay par at each level, will you?
So I'm looking at the most recent Conduit deal that priced. So the A1 class, which had a 2.5-year life. So you're getting paid all the money right away, and in 2.5 years, you're going to get all your money back. That price that just about par, 99.998% of par. I don't have the coupon here, but it was priced to yield 4.073. So the next class, which had a 5-year life, priced at 103%, and that's yielding 4.059. And each one of them has a slightly different coupon.
And these are totally tradable as well. So you buy it today and sell it tomorrow. That's the whole point, isn't it? Liquidity. That's
right. And of course, the bond classes at the top are more liquid than the ones on the bottom. The further down you go on the capital stack, the fewer investors. The market isn't as deep as it is up on top.
Fascinating. Orest, thank you so much. And I tell you what, do me a favor. I didn't actually ask you to do this. So I'm going to ask you, if you don't mind now, please tell me just briefly who you are and how is it that you know so much about this?
So, all right. I'm Orest Mandzy, as you know. And so I'm the managing editor of Commercial Real Estate Direct. We're a news and information publication, a subsidiary of Trepp, Inc., that covers the CMBS market. They cover the commercial mortgage market with a sort of a deep background in CMBS. They have the largest library of domestic CMBS deals extant. And we're part of that operation. So we track deals that come to market, and they track the sort of the nuts and bolts of each deal, how the collateral is doing and things like that. And I've been covering CMBS since the first issues came to market in 1995. So I kind of picked up a few things here and there.
You are the ultimate authority on CMBS.
Yeah, I wouldn't say that, but
I know you wouldn't, but you're far too modest. All right, so let's roll into, so for anybody that is listening, in years to come, we are going to discuss now for a couple of minutes. It's June 21st, 2022. The world is changing very, very rapidly right now. So if you're listening in 23, 24, 25 or beyond, for historical purposes, you can find out what we were thinking today. But if you are listening right now, what Orest is going to tell us about what's happening to CMBS could determine what you decide to do in the next few months. What is happening to CMBS right now? What are we learning from it?
So Adam, as we mentioned before, CMBS is a key pricing mechanism. It's used to price loans, whether you're keeping them on your balance sheet, whether a life insurance company is writing loans to keep on its balance sheet. It's determining how to price those loans, partially from the CMBS market. But the CMBS market has been widening out. That the terms that some people use, and that's because of a risk-off mentality by investors. They don't, but and it's not only CMBS. It's happening across all fixed income securities. The fear of inflation has driven investors to require greater yield from their investments, all things remaining equal. So we see what we've seen since the beginning of the year. The 10-year Treasury has ballooned to 3.3% from 1.63%.
So that's a massive, huge. In how long? That's like in the last 6 months. 6 months.
Yep. And again, I mean, I'm sure if I looked at February till now, it would have been as dramatic as well. But so while the data that we have access, we see, and data again are all backward looking, doesn't show a dramatic widening in the loan spreads, meaning the risk premium that lenders require in writing their loans, right? Lenders will lend you money based on a risk-free rate of return plus a premium, and that premium should offset any risk that they assume.
And the risk-free rate is the 10-year Treasury. That's right. 3.3
for fixed rate loans, right? The risk-free rate for floating rate loans is SOFR now. But so we've been told that the loan spreads have climbed. That hasn't sort of materialized in deal information just yet. But a new deal just crossed the transom this morning, but I didn't get a chance to.
So when you say the yield spread has climbed, what the implication is then that people are looking for a bigger yield, a bigger difference between the 10-year Treasury and what they're getting?
That's right. So what lenders are requiring a bigger premium, a bigger risk premium than they had been getting before.
Is that because they're anticipating that 10-year Treasuries will continue to go up?
Yep. Yeah, that's probably the root issue. There are other sort of other issues related to sort of an economic slowdown and things like that. If the economy slows down, the risk for potential defaults is greater, so you want to get compensated for that risk.
And what that means, what you're describing here is that means commercial borrowers are staring down the barrel of significantly higher interest rates to finance their deals.
That's correct. And that in and of itself is resulting in a decline in property prices.
Yes, indeed it is. Orest, thank you so much. I'm so grateful to you for filling this gap.
My pleasure.
It's a real pleasure always to see you, and I'll be in touch again soon.
Thank you. Take care.